Hi, this is Thomas. Welcome back to the course Financial Institutions and Markets. Today we'll be discussing the topic of capital markets, bonds. Let's begin by talking about a general concept for all financial markets, not just capital markets. The primary market versus the secondary market. The primary market is where issuers obtain capital. This is the market between issuers and investors. So when an issuer wants to raise capital, typically by selling bonds or equities, they go into the financial markets, they sell, an investor buys, and the issuer receives funds from that investor. The secondary market is the market for existing securities. This is buy and sell between investors, a sale from one investor to another. In secondary market transactions, the original issuer isn't involved. This issuer doesn't participate in the transaction, isn't receiving any funding, and isn't directly affected by any change in pricing in the securities since the original issue. Now, characteristics of bonds. Bonds are typically long-term securities issued at a fixed interest rate, and as market rates aren't fixed, as market rates change, bond prices change because the fixed interest rate is a very different characteristic than a variable interest rate, which is the kind of interest rates we have in the market. And we'll see more about how interest rates affect bond pricing later in the lecture. Bonds typically pay interest semi-annually, which means 2 times a year, every 6 months, and some bonds have additional features. A callable bond means that the bond can be repaid early at the decision of the issuer. A puttable bond means that the bond can be repaid early at the decision of an investor. So for a callable bond, this feature is favorable to the issuer. It gives them additional flexibility. A puttable bond is favorable to the investor because they have additional flexibility. And finally, convertible bonds can be converted to equity, to ownership in the entity. This is at the decision of the investor, and this is a feature that is favorable to the bond investor. Next, important bond concepts. Let's compare par value and market price. Par value is the face amount of a bond. So when a corporation issues a bond, the bond will have certain terms. The par value is the amount of the bond. The coupon rate is the interest rate paid on the bond. There will be an issue date. There will be an end date at which time the bond will be repaid. So these are features that are in the bond certificate. So the par value is on the face of the bond. That's why it's also referred to as the face amount. It's on the face of the piece of paper that is known as the bond certificate. The market price, on the other hand, is the bond price based on market yield. So in the market, the bond might trade. The bond might be sold from one investor to another, and that sales price is going to be based on what market rates are at the time of the bond sale. And as we've already mentioned, because market rates change, actually they're constantly changing, and bonds are issued at a fixed rate, then that change in relationship between the coupon rate of the bond and the market interest rate, or the market yield, affects bond pricing. Next is coupon rate versus yield. The coupon rate is also a feature of the bond on the face of the bond, on the bond certificate. This interest rate is based on the face amount or the par value of the bond, and it is a payment, again, usually paid semi-annually, and that payment will not change during the life of the bond. The yield, in comparison, is the bond return based on market price, and we'll see later how yield and price relate to one another. But note here that the coupon rate does not change, but the yield will almost continually be changing because market rates are almost continually changing. And finally, a calculation. Coupon payment is the face amount of the bond times the coupon rate divided by the number of annual payments. And for most bonds, payments are semi-annual, which means there are 2 interest payments per year. Accrued interest is a calculation that occurs when a bond is sold between interest payment periods, which is most of the time. Again, bonds typically pay interest 2 times a year, so there are only 2 days in a year which don't require interest accrual calculations. Any other time a bond is sold, an accrued interest calculation is necessary. The accrued interest is referring to the interest that has been earned on the bond but hasn't been paid yet. This is the amount of interest that the issuer owes from the date of the last interest payment up to the current date. And the calculation is coupon payment times days since last payment divided by the days in the coupon period. So here we have an example to calculate the accrued interest given the following bond information. We have a $5,000 bond with a coupon rate of 6.24%, semi-annual payment twice a year. The last payment was 42 days ago, and this current payment period is 182 days. So we use the formula that's given above in the first half of the slide to complete our calculation. First, the coupon payment. The bond face amount times the coupon rate divided by 2, because there are 2 payments per year for a semi-annual bond, gives us a regular payment, a periodic payment of $156. That's paid twice a year. The accrued interest calculation. If we're 42 days into the current period, then we multiply $156, that's the complete coupon payment, times the fraction 42 days over 182 days, which is the total days in the payment period, and this gives us an accrued interest amount of $36. So if we were to sell our bond today, or we're purchasing a bond from a seller today, this bond, given these terms, we would pay an additional $36 to the seller, because the seller has earned $36 in interest that once they sell the bond, they're not going to receive from the issuer. The issuer is going to pay interest to the bondholder. If we're acquiring the bond, we are the new bondholder, and we will receive the full coupon payment on the coupon payment date. So what we're doing now is we're paying the portion of the coupon payment that was earned by the previous investor to that investor at the sale of the bond. And when we receive the full coupon payment, we've settled that difference. We've already paid in advance. We've paid the portion that's due to the seller, and we keep the full payment, which effectively we're not earning. We've paid a portion of that to the previous investor, and now we receive the full payment from the issuer. Let's break here, and when we return to the lecture, we'll take a look at the concept of yield.